Welcome to the weekly update, where we'll go over the action in the market for May 16th through May 20th, and then we'll see how things look for May 23rd through the 27th. Let's go back over some of the things that happened in the past week. The S&P briefly entered bear market territory, especially on Friday. It dipped down to about the 38.55 level and even below that slightly, but then was able to come back out of that and stage a pretty impressive comeback on Friday. That was really the most positive thing that happened. Other things that happened during the week was there was real disappointment over corporate updates as well as the economic data that came out, which is producing a lot of growth concerns. Fear is really extreme, and any attempts to try to rebound from excessive fear just failed. There was this impressive rebound on Friday from the lows that made it back up to 3,900, but it was options expiration for the monthly options, and 3,900 is a pretty important strike price. So we're trying to see, was the rebound because we're getting set to go higher, or was it because Friday had options expiring and 3,900 was a very important level? There was a lot of disappointing economic data that came out. Earlier in the week, the May Empire State Manufacturing Survey, it turned negative to minus 11.6, where there was an expectation that it had been at 15. The weekly jobless claims ended up being higher than expected at 218,000, where they expected 200,000. The Philadelphia Fed Index dropped to 2.6, where they expected it to be at 16.5. The Conference Board LEI, leading economic index or indicators, decreased 0.3%, where they expected it to be unchanged. Existing home sales fell 2.4%. Building permits fell 3.2%. Weekly mortgage applications fell 11%. Also, Fed Chair Powell spoke, but he pretty much just said what the Fed has already been saying, so the markets didn't really react to that too much. So we ended up being down 3.05% for the week. Volume was above average. What we're really fixated on right now are the technicals, and they're pretty much negative on the daily charts as well as the weekly charts. Inflation and interest rates, and with that comes a real concern about growth. Geopolitical concerns that pretty much are the same as what they've been. The supply chain issues and the lockdowns in China, it's my understanding that they're starting to lessen those, so that could possibly help things improve. Oil is just going all over the place and is still very high. Anytime somebody from the Fed comes out and speaks, that can drive the markets either higher or lower, and then earnings as they come out. Our trend condition is strong, but it's a negative trend right now, and I'll show you a chart of that. Here is the week in review, just going back and looking at this, where on Monday, didn't really have too much right off the bat. We kind of chopped above and below the daily pivot line. We tried to go higher, but then ended up finishing lower. Tuesday was the most positive day of the week, where we gapped higher, fell back a little bit, and then ended up closing at the highs. And it looked like, okay, maybe things are going to get better from here. Well, no. Wednesday, we gapped lower and then spent the day just really declining overall. That was a very negative day. Thursday, kind of chopped sideways and didn't really see all that much happen. Friday, it looked like, okay, we're going to get a positive bounce here, but no. That quickly saw some selling. That took us down below S1, even below S2. Right in here was where the S&P started to enter bear market territory. From that point forward, we saw a lot of buying come back in, and we ended up being unchanged on Friday, but there was some real strength late in the day. For the week, the Dow was down 2.9%, the NASDAQ was down 3.8%, the S&P down a little over 3%, and the Russell 2000, the small caps, down 1.1%. And here is just a representation of how things were acting during the week. The small caps were down the least at 1.1%. You have the NASDAQ 100 down the most at 3.33%. So all of the indexes ended up being negative overall. The different sectors, some were decidedly negative. There were a few that were positive. Staples, which had been doing well lately, it's just getting hammered these days. Discretionary, which has been weak, showed continued weakness. And let's see, some of the ones that were up. Utilities were up slightly, healthcare, and energy, which is the number one sector of 2022. And this just shows how things acted during the week on a more graphical basis, with staples having a lot of weakness. Current market valuation. It currently says that we are fairly valued for the S&P. And here are the different parts that make up their model. The yield curve is still fairly valued, and this yield curve never went inverted. There's other yield curves that did go inverted, but this one did not. And these are live charts behind this graphic here. We're down in the fairly valued area. The Buffett indicator, which compares stocks with GDP, after being really extreme, it's still pretty excessive, but they're rating it as more fairly valued on a comparative basis. The PE ratio continues to be overvalued, even though it was a lot higher. Interest rates, even though they're historically low, are considered to be fairly valued. Margin debt, which the latest information was from the end of April, has really been trailing off. And the mean reversion, this is how far away are we getting from the mean price of the S&P. And we had been really excessive earlier in the year. Well, with the recent declines, we're still overvalued, but this has really been dropping. Sentiment, as of Friday, is still extreme negative. We're way over here at 11. And here's a historical chart, which just shows we've been camping out below 25 for quite a while now. A lot of people are fearful, and there was the thought that you use this as a contrary indicator, and once we get down to these lower levels, well, maybe we see a bounce out of that. And there were a few tries, but they never really led to anything, and fear continues to be pretty extreme negative. The Ridex bear to bull ratio did spike up in the previous week, but it actually came down a little bit to 0.10 in the latest reading. Then the AAII, individual investors, even though this improved, they're still pretty negative overall, and we often use this as a contrary indicator. The VIX spiked up just a little bit for the week on a closing basis, and it's been acting kind of strange. And I've been trying to go into a little bit more detail on this in the daily videos. The Ulcer Index continues to go up, and there's no upward band on this. This can go as high as it wants to go, but this measures fear. Also looking at the Chicago National Financial Conditions Index, it is going up over here on the right-hand side, but as long as we stay below this black line, that means that things are okay. But we are getting closer to that line. Another thing is the spread between risky loans and non-risky loans. It is going up with the economic weakness, but it's not necessarily excessive, where we've really spiked up previously. Another interesting chart just shows that the fund manager survey of those that are expecting a stronger economy, it's very, very low. And you can see other times when we read readings similar to right now, and usually bad things happened after that. We also had the asset managers who actively manage their funds or their hedge funds or their mutual funds. They are also giving us a really extreme negative reading at 19.51. That report came out on May 18th. Another thing is, you probably have heard about the president is having real trouble with approval ratings. Well, you can tie that a lot to inflation. As inflation is going up, the president's approval ratings are really going down, even though they've bounced up a little bit. Another thing is insider transactions. When we're below this black line, that's considered bullish. When we get above this black line, that's considered bearish. Right now, we have a reading of 6. So this could add some support. These are legal insider transactions. Insider trading, there's a legal kind and an illegal kind. This is the legal kind, where people that work in the company and they have to announce what they're doing, and there's certain guidelines that they have to follow. They tend to really understand what's going on in the company. So if you want to pay attention to what's really happening, pay attention to what these folks are doing, whether they're buying or selling. And this is a whole investment philosophy. People base it all around what they see happening inside of a company. Earnings and valuation. I went to FactSet, and there are a couple articles posted here where it just says the S&P, it has the largest negative price reaction to positive earnings per share surprises since 2011. And what this really says is down here over on the right side, even though they're surprising to the upside when they come out with their earnings, their stock is still getting hit anyway. And we're seeing a lot of that. Another blog post was that the S&P forward PE, I tend to use the trailing PE, but this is the forward PE. It falls below the 10-year average for the first time since 2020, which was pretty bad times. That just brings things more down into a more fairly valued situation based on the PE ratio. For the most part, stocks are fairly valued right now. But this is looking forward. These are forecasts. These are projections. These are open to changes and modifications, where the other charts that I'll show you later, they're based on the trailing 12 months and historical averages. Those are factual numbers that don't change unless somebody goes to prison for that. Also, another article shows that 85% of the S&P companies are citing inflation when they're coming in and talking about why are things not going so well right now. Most of the time, they're saying inflation, inflation, inflation. Here's the trailing 12-month PE ratio where we're finally dropping down below this zero line down below. And this just shows that we're still pretty expensive. At least we're coming down from being excessively overvalued. Now, if we want to get back to fair value based on the trailing 12 months, we're going to have to come down to the blue line right here. And if we want to get to be cheap, we're going to have to come all the way down to the green line. And here's the corresponding values of what the S&P 500 would need to be. This is also just a representation of showing what has happened in the past. Here we have the 1987 crash and where the valuations were at that time, the dot-com boom and bust and how the market got way ahead of earnings, the housing crisis, where eventually the market actually underperformed the expensive PE ratio, but then from 2015 all the way up to the COVID plunge, pretty much the market was expensive at that point. Well, after the COVID plunge, the market had been very expensive, and now we're starting to come back down. FedWatch, just to update on this, for the meeting coming up on June 15th, there's a 94.9% chance that we will be at 1.25% to 1.5% interest rates after that meeting. Here's a historical chart. If you want to pause, you can look at this. At the July 27th meeting, there's a 94.7% chance that we'll be at 1.75% to 2% after that meeting. Here's the corresponding historical chart. The Fed balance sheet, the most recent one that I found, was updated on May 17th, and it just shows that we're under $9 trillion, but for the week, the balance sheet actually added $3.89 billion from the previous week. So it actually went up a little bit. We should start to see this coming down as the tapering plan that the Fed has in place starts to kick into gear. Breadth. We're still negative overall based on price and volume. We saw a little bit of an advance based on price, but we're still declining. When we're talking about volume, the advance decline ratio is still showing some improvement, but we're below zero. New highs and new lows are trying to bounce up, but we're still looking negative overall, where our 10-week moving average goes back and is pretty much flat to declining. Accumulation distribution just shows that we are negative right now. There's more people selling than buying, according to this chart. As far as our trend, the ADX, which is the dark line, it is advancing and above the moving average. The red line's on top. Even though it decreased, buying, the green line, also decreased. So overall, we are in a negative trend right now. The mass index is also trying to give us part two of a signal, but it hasn't happened yet. We have gone above 27, but the second part of that signal is when we fall down below the dashed line, and that hasn't happened yet. Long term, decision point scorecard has not changed and looking either neutral to negative overall. The pivot points, this is more pronounced on the daily chart, but we actually fell down below S1 on the daily pivot level. And down here at the bottom, you can see where volume wasn't as strong as the previous week, but it was still above average. We are below the 50-period simple moving average. We are looking at a negative trend when we compare the 13-week to the 50-week moving average. The bullish percent index is down below 30, so that is negative. The Chaikin oscillator is trying to bounce up after being extreme negative, but is still negative overall. Chaikin money flow is also pretty negative right now. The force index has been declining. That's also negative. The McClellan oscillator is below zero and declining, so that's negative. Summation index based on price is declining, as well as on volume. So we're just seeing lots of negativity right now. Our oscillators are pretty much still heading lower overall. The PMO continues to decline. Based on price, it's declining, and based on volume, it's also declining. Those PMOs that are rising declined in the past week. We saw a bit of a bounce with those that generated buy signals. Those that are above zero continue to decline. Relative strength, declining and getting near an extreme negative reading. Special K is still positive. It's above the moving average, but it is rolling over. But this takes a while to really change. The STO, we're trying to bounce up a little bit based on price, trying to bounce up based on volume. We're a little bit positive with the price, but we're still negative based on volume. The Stochh RSI is pegged negative. Williams percent R, also extreme negative. Vortex, red line is on top, even though it declined, is still negative, with buying power also decreasing. Ultimate oscillator bounced up just a little bit, but is still decidedly negative overall. Money flow index is also falling and could eventually fall into extreme negative territory. The Bollinger Bands, based on the percent B, how far outside of the Bollinger Bands are we? We're not really giving an extreme reading, but we are negative and declining. The KST, which you can choose to use this or not, this can be a really good indicator, but other times it really would have led you in the wrong direction because it was showing a decline as things were really going up in 2021, but it is still negative right now. The percentage price oscillator is also showing a decline. Rate of change from 1 week, from the previous week, we actually declined a little bit because we were down on the week. The rate of change going back 50 weeks is also declining and below zero. The Copic curve is not turning up. We're starting to see this turn up a little bit on the daily charts, but it's not happening on the weekly chart. Fib retracement. This is what's interesting. Here we have a weekly chart of the S&P, and I show this in my daily video, where we came all the way down to the fib retracement level of 38.2. And that was measured from the COVID low up to the all-time high. So this is a pretty significant level. If we can bounce up off of this, that could be positive. Our different charts, the Heiken Ashi is negative. Kegi is negative. Renko is negative. We also are looking more negative on the point and figure chart where we have a pattern called a double bottom breakdown. And that was generated on April 11th, where we added another zero in the past week, which is negative. Three-line break is also negative and declining. Our different trading systems, the Elder Impulse is negative. The parabolic SAR continues to be negative with the dots on top. Looking at some broad market indexes, here's the S&P, the mid caps, and then the small caps, just to give you a look of how they are performing together. All stocks, comparing U.S. and non-U.S. stocks, is in a real decline. Mid caps also in a decline, and you're going to hear a lot of the same thing here. Recent death cross, way below the moving average. Small caps, death cross, below the moving average. Dow, same thing, even though it's been holding up a little better. NASDAQ, also looking quite negative. NASDAQ 100, negative. NYSE, negative. Wilshire, negative. FANG stocks, negative. My goodness. ARK, negative. The 30 biggest software companies, also negative, were well below the moving average. Looking at the broad market, the CRB index is still in a really strong uptrend, and it was up 1.34% on the week. Gold had been having some trouble. On the daily chart, it started to fall below the 200-day moving average. Here, it fell below the 50-period moving average, but we were able to get back above that. Silver is also looking at a potential death cross on the daily chart, and it's not looking all that good on the weekly chart either. Oil is at 110.28. The dollar, which had been doing quite well, saw some weakness in the previous week. It actually declined 1.38%. Relative studies. We still have bonds really underperforming stocks, but that is looking to improve right now. What we want to see is this green line continue to go up and eventually see a cross of the moving averages, but we haven't seen that yet. On the monthly basis, stocks have been really outperforming bonds, but that is starting to show some weakness currently. Looking at an intermarket analysis chart just shows, and this is daily, this just shows that oil has been performing the best. The dollar has been doing fairly well. Gold, not so great. Not what a lot of people had hoped or expected, where the S&P has been down and where bond prices are bouncing up a little bit but are still negative overall. The gold to the US dollar ratio is still negative but trying to bounce. The gold to the S&P is still showing that even though the S&P is declining and gold has run into a little bit of trouble, gold is still outperforming the S&P. The low volatility stocks continue to outperform the rest of the S&P 500. Now, it doesn't mean they're not going down. It just means that they're going down less than the rest of the S&P 500. The growth to value ratio just shows that growth is really underperforming value. And growth is where we get the really big returns from, the really big up moves in the indexes. NASDAQ 100 is really underperforming the S&P. S&P 100 is underperforming the S&P 500. Discretionary is really underperforming staples. And energy is really outperforming tech. So what's our outlook for the upcoming week? On Tuesday, we have new home sales that are coming out. Wednesday, durable goods, and then we get the FOMC meeting minutes that will be released. Thursday is the second estimate of GDP. Then on Friday, we have personal income and spending, PCE prices, the final result of the University of Michigan Consumer Sentiment Survey that they do. Things to watch to technicals. Yeah, we're negative. We need to see follow-through with any attempted bounce. The real concern right now is inflation and interest rates, a lot of geopolitical concerns, such as Russia, Ukraine. We also have supply chain issues. We want to keep an eye on oil, the Fed, earnings as they come out, which even if they're stellar, sometimes leads to a real sell-off in the stock. And then a longer-term scenario with Japan that has been developing for decades, and we're really keeping an eye on that. And I'll go into that in more depth in future videos. So what are our scenarios right now? We are down because of rising interest rates, inflation fears, and growth concerns. Earnings, Fed speak, fear. Technicals are quite negative right now. Things that could help us go up is that we're seeing some oversold readings. Sentiment is very extreme. And then there was that impressive rebound on Friday. Can that follow through into the coming week? Possible positive scenarios that I discuss in the daily videos, none of them are really happening right now. One of them, the spike in the staples to S&P, has really been declining, and sometimes that marks a bottom in the S&P, but we're not seeing a follow-through in price yet. The technicals, yeah, we're really oversold. Pivot levels, previous levels, fib levels may provide either support or resistance. We're not in a sideways market right now because the ADX is above 20 and is showing a negative trend. So thank you. I hope you have a wonderful week, and I'll prepare the next video next weekend.